Hey guys, so if you, today we're going to be doing section 3.6 of IB Business Management. If you want me to continue doing these videos, making these videos, please like and subscribe and ask any questions you have below. So let's begin. So we have to talk about efficiency ratios. So efficiency ratios are how firms really assess how they internally utilize their assets and their liabilities. Remember, we discussed assets and liabilities in our two previous videos, 3.4 and 3.5. So we know that assets and liabilities, they can either be short term or they can be long term. Short term is basically when they're less than the year, and long term is when they're for more than a year, right? We do know that we have non-current assets and current assets. They stand for long term and short term. Okay. Now let's continue because we got into these in the previous videos. If you wanna get into lessons of the previous videos, then you can always watch them. They're up already. And they help analyze performance of a firm. Okay, so how the firm is performing. So the first ratio we have is stock turnover ratios. So stock turnover ratios measures how quickly a firm's stock is sold and replaced over a given period of time. So meaning how quickly they end up producing, they then sell the stock. So they produce and they sell. So the faster that is, the better, because that means that they're selling at a high rate, right? I'm going to be explaining this further. So we have it in two ways though. It can be over a period of time, so number of times, or it can be number of days. So that's quite different. So for times, you just end up dividing cost of sales by average stock, right? That's it. But for days, it's quite complicated. For days, you actually flip it. So it's average stock over cost of goods sold, and then times 365, because again, we have 365 days per year. Okay. So a higher stock turnover for number of times is preferred by business. I'm gonna explain why right now. Um, okay, why? Basically, because we do know that total revenue is basically price times quantity, and profit is basically total revenue minus total cost, right? So when our quantity increases, so does our total revenue, because when they have a high stock turnover, it means that they're selling a lot of their stock, and they're selling it at a pretty fast amount of time, right? Because they're selling it a lot, because it's number of times. So the more they end up selling their stock and replacing it, that means that they're selling a lot. Okay. So basically an increase in total revenue is gonna cause an increase in profit. So this is how it really works. Okay. Um, a lower stock turnover in number of days is preferred by business. Why? Because basically for stock turnover ratio in number of days, that means that the lower number of days it takes them to replace um their stock, the better, because these two are quite different. I'm gonna just explain how right now. So basically number of times means that, for example, let's say they replace their stock 12 times a year, once a month, right? Okay. But their stock turnover ratio in number of days, let's say, is 31 days. Okay. So that's like the average month, or like 31 to 30 days. Okay. Basically, that's equivalently the same thing, right? But let's say that if they end up replacing it twice a month, okay, so we're gonna say they end up doing it twice a month, right? So that's gonna be approximately, so I'm gonna use different colors so you guys can see it. So approximately that would be 24 times a year, right? But in this case, it's gonna be every 15 days. So you get me? So now this translates for the same thing, because number of times means how many times they're actually selling all of their stock and buying new stock to sell, or producing new stock to sell. Whereas stock turnover ratio is basically the number of days it takes them to sell. Okay, so that's the difference. That's why one should be low and one should be high. Should be high, should be low, because If this was low, means stock is not getting sold. Why? Because it may be because there's no demand for the stock, the economy, there's a downturn in the economy, whatnot. This depends on the context of the case, which is not what we're studying now, but always no context. But for now, note that if stock turnover ratio number of days is high, it means it's taking time to sell the stock. Okay, that's why. So that's the difference. You got me? Now to continue. Generally, the faster the business turns over its stock, the better it has to at profitability rather than selling stock at low gross profit margins or even worse at a loss. Okay, so like I explained, meaning that the faster they sell the stock, the better, because that will generate more profit. Okay. It indicates that the firm is okay, so basically it indicates that the firm is selling its stock quickly, thereby earning more profit from its sales, exactly like I explained here. Furthermore, the goods do not become obsolete quickly and perishable goods do not become expired, showing that a firm has good control over its purchasing decisions. Okay, this is very, very important. Why? Because a lot of goods are perishable. I'm going to explain what perishable is. Okay, so obsolete means that they're just no longer trendy. There's newer and better in the market. Newer, better substitutes slash options. Okay, in the market. So I'm just going to write market here. But perishable goods are goods such as food that expire. Okay, so they don't last for a long time. So if they sell their stock fast, they get rid of their stock fast, that means that the firm has good control purchasing decisions. And not only that, but also you have storage costs. So storage can mean rent costs because they might be I'm renting the storage area, and also means utility cost, electricity and water. No, I don't think water specifically, but electricity for sure. Okay. So yeah. So that's why there's so many things that have to do with storage as well. So you can always get into that as well when if you have a 6 mark or 10 mark, even a 4 mark, you talk about that, right? Because again, in these situations, you talk about so many things. You need to talk about your the number you get. So the calculation. So first you have to start with the calculation, then you have to talk about the context situation of the business, and also when you discuss storage, uh you also have to discuss the negatives about storage, right? So this depends on the case, but now I'm just giving you the information, right? If you want to solve case studies, then you can either comment down below on which case you want me to solve, or we can do some private tutoring. Anyways, stock turnover ratio is a good instrument for assessing working capital management. Okay, so how they manage their capital. Working capital management is the assessment of the way current assets and current liabilities are being administrated. So current assets, current liabilities, they're short term. So it means that they're less than 12 months. Current assets are like cash, debtors, stock, and liabilities are just like short-term loans. Liabilities are short-term loans, okay? Strategies to improve stock turnover ratios. So slow-moving or obsolete goods should be disposed of. Okay, so basically they get rid of them. They get rid of these goods, which will help the firm reduce its stock, its level of stock. This downside is that this will lead to losses because they don't end up selling it. Okay, so they'll get losses. So since the firm will lose the sales revenue that these goods generate. Okay, so basically the firm was supposed to make sales revenue from that, right? Because sales revenue, like we discussed, is price times quantity. Okay, but they actually don't end up selling it, they just get rid of it. Okay, so they will save storage costs and it will increase the ratio, but they're gonna end up making losses because the whole point of producing these goods was to make sales revenue, which was gonna translate to high profits, so they end up losing. Firms with a wide range of products need to sell a narrower, better range of products However, disadvantage that they will minimize the variety of products offered to customers. Okay, so basically, what they could do is that they could see, oh, the least popular product among customers, a product that isn't really needed, a product that isn't loved as much, but at the same time, they won't be offering customers such a wide range. So yeah, and they could, if you're talking about the case, you could also talk about like market research and whatnot. Now, another thing they could do is they could keep low levels of stock. So that would reduce the cost of holding the stock. So reduce the cost of holding the stock, low levels of stock. I talked about that here. However, the disadvantage is that if there is a sudden increase in demand by customers, um, businesses with low levels of stock may not be able to sustain in the market. Okay, meaning that okay, they have low levels of stock, they only get the stock when they need to sell the stock. But at the same time, sometimes there might be like a really high demand in the market because no things get trendy in the market. It's a lot of the times unanticipated. So this may be a disadvantage. Some firms are able to adopt the just-in-time production method. So this is something we learned in section 5. But basically, just-in-time means that they only like produce the product if they know they're gonna sell it directly automatically. Our stock is only delivered when needed, basically. However, if there are any delays in the raw material, this could definitely negatively affect the production and sales. Okay, so basically, it's just in time, right? But there's so many things that could go wrong when it's literally happening just in time, right? Whether it's a problem with the supplier, whether they just arrive too late, there's delays, whatnot. So this can actually jeopardize it. Okay, so they will be saving on the storage cost. They'll definitely be saving on specific costs, right? But at the same time, there's so many risks. Okay, so you can talk about this in time being risky. Okay. Now for our second ratio, we have debtor days. Okay, so debtor days, it measures the average number of days a firm takes to collect its debts. Okay, number of days. So times 365, because it's number of days, we have 365 days a year. Debtor days measures how many days it takes on average for a firm to collect its debts from customers. It has sold goods on credit, meaning when they sell them good on credits, mean that they give them the goods, but the customers don't pay. They end up paying them later, which makes the customers debtors. Okay, so these customers in this case, they're debtors. Okay. It assesses how efficient businesses are in credit control systems. Um, the shorter the debtor days, the better for the business, because that means that these customers that are debtors are paying faster for the goods that they bought on credit. This is because it provides the business with working capital. So working capital is used to run its day-to-day operations. Okay. Um, and it can also invest money into other projects, right? So they can pay their rent bill, their electricity bills, the salaries for their employees, whatnot. It can also invest money into other projects, like I previously mentioned. Allowing too long credit periods can lead to cash flow problems because they won't have money to pay for their everyday bills for the business, and cause a liquidity crisis. Liquidity crisis basically not enough cash, okay, cash to pay for day-to-day operations, right? The business won't be able to survive because their outflows are gonna be more than their inflows. Basically, if you know the whole curriculum, you're gonna know what I'm talking about. If you don't, this is section 3.7 for cash flow. So if you're studying for official exams, and you should know that if you're studying for just the exam at school, then you're fine, I guess. But I'm gonna be making a video for 3.7 soon. It's probably already up when you're watching this video. Possible strategies to improve debtor days. So a firm can provide discounts or other incentives to encourage debtors to pay their debts earlier. However, the drawback is that the business will receive less income from these customers than originally agreed, okay? Because discounts basically. So basically, what discounts mean is that the price will decrease, right? And total revenue is basically price times quantity. So profit, okay, so I'm just gonna write profit because then we copy the profit is total revenue minus total cost, right? So basically, a decrease in price will lead to a decrease in total revenue, which will lead to a decrease in profit. Okay, so this is how this will lead to a loss, right? That's the first point. So they will receive less income from debts earlier than these customers originally agreed. A firm might impose stiff penalties such as fines for late payments which will cause customers to make an effort to pay the business on time, and the business will make more money than agreed on. So they'll end up actually having the opposite. So they'll get a higher price, higher total revenue, so higher profit. Okay, in this case, but however, the business may lose long time loyal customers. So this might backfire. So this plan may backfire. It may jeopardize brand image, right? Okay, so you should know this term if you're studying for your official exams. A firm can stop any transactions with late debtors until payment is finalized. This does not guarantee payment. This is not guaranteed payment, and the debtors might opt to other suppliers for the goods. Okay, so basically, this doesn't mean that they're gonna get paid if they just stop transacting with them, right? If they stop working with them, and they just might go to other suppliers and not end up paying them at all. So they might be like, okay, since you're not, we don't need it, since you're not responding to us, that means that we can't take anything from you. That means that we no longer need you. That means that we're not going to pay you anymore. Okay, so this is all gonna what's gonna happen. So then the last part, that the business can resort to legal means such as court action for constantly late payers. However, this is harmful for the reputation, brand image of the business, and it's costly too. So this is like the worst option possible, just because it's gonna tarnish the brand image, meaning that, okay, so basically this like business is problematic with its own customers, doesn't treat its customers well, and not only that, but they're gonna end up paying so much for lawyers, and then they're gonna end up paying so for the lawyers, for the court fees, and all of that. But not only that, then they're gonna actually have to pay for like marketing agencies, or have to like invest so much in marketing to rebuild the brand image that they already ruined. So this is like probably the worst option they can do. So now creditor days. So creditor days measures the average number of days a firm takes to pay its creditors. So that's for the firm to pay its creditors. Okay, so the formula is creditor days ratio in a number of days. So it's times 365, because you have 365 days per year, like I said, 3 times this video. So the formula is creditors divided by cost of sales times 365. A high creditor days ratio enables the firm to use available cash to fulfill its short-term obligations, right? However, allowing this period to extend too long may strain the firm's relationship with its suppliers, leading to future financial problems. In addition, other stakeholders such as investors may consider the firm as financial troubles, and you consider investing in. So be like, okay, this firm is not paying their investors. They're obviously, I mean, not the investors, they're creditors. They're obviously having, they don't have much money. They don't have much cash. They're short on money. That means that they're not profitable. They're not making money. They're going bankrupt, or I'm kind of over exaggerating it, but basically the firm is not doing well. So this is gonna kind of jeopardize the brand image, okay, a reputation of the firm. So future possible investors be like, okay, so I'm not gonna invest in this because I don't think I'm gonna get my return back. So it's just generally just gonna make the firm look like they're having financial problems, because okay, having a long high credit days ratio will help the firm, because they're going to be able to pay for the day-to-day expenses at a faster rate, but at the same time, it's going to cause some other problems. Another strategy is okay, so possible strategies: having good relationship with suppliers may enable firms to negotiate for extended credit period. However, suppliers may refuse to give the firm an extended credit period and refuse to support the business in the future. Okay, so they might say, okay, no, we don't want that. We don't agree to that. Find another supplier who's willing to do that. Okay. So this, you can say this is not guaranteed to work. Okay, so not guaranteed to work. Then you have effective credit control will improve credit days ratio. Managers will need to assess risk of paying creditors early versus how long they should delay in making their payment. This is not easy to take and will probably depend on the cash flow of the business, like I previously mentioned, and their current needs. Okay, so basically this will be down to the managers. This is very context based, meaning that it's really based on the case that you have and the situation that the business is in. Gearing ratio. So gearing ratio, basically, what is the gearing ratio? Gearing ratio basically measures the extent to which the capital employed by a firm is financed from loan capital. Okay. The gearing ratio is basically loan capital divided by capital employed times 100. Okay, when it's times 100 means your answer has to be in percentage. Keep that in mind. Loan capital is a non-current liability. Okay, meaning it's long term in the business. Capital employed includes, so basically capital employed includes loan capital, share capital, and retained profit. A business is seen as high geared if it has a gearing ratio above 50%. Okay. So above 50% means that it's a high geared. It's above 50%. Okay. Um, a high gearing ratio could be viewed as risky by financiers who may be reluctant to lend the business due to the large debt burden. Okay, so basically, when they have long-term liabilities like long-term loans, because all of these are like sort of loans, what's gonna happen is that they're gonna seem like, okay, they have this really high gearing ratio. That means that the firm has a lot of loans. That means it might not be financially sound. That means that it has so much to pay for, that we just don't want to like really invest in it because it seems risky. It there's a really high chance it might go bankrupt, because bankrupt's when the firm can't pay for its debts, so they end up selling their assets to be able to pay for its debts, right? So this seems risky to investors. Shareholders and potential investors will be concerned about high-geared businesses, as they may not foresee that dividends, as um, the business's obligation is to pay their long-term loans. Okay, so they'll be like, okay, so basically dividends are when after the firm, like when the like fiscal year ends, whatever, like the business year ends, what happens is that before that the if the like profit is positive, like if the firm is actually able to give the shareholders dividends, which is like the returns for their shares, because they invested in the business, right? So they need returns back. So dividends are sort of return. So when these investors see that there's no possible return because of these high loans, they're gonna be like, okay, the profit is positive, the profit's pretty high, but the profit's not gonna go to us. It's not gonna go to paying us dividends. It's gonna go for paying the long-term loans. Okay. Any business interest rate will worsen loan payment position of such businesses. A business has okay, so basically they're saying that an interest rate will increase the loan repayment. So basically, they have so many loans already, but they also have an interest rate, right? And especially that it's non-current liability, meaning it's long term, this is really gonna take time. A business has a low gearing ratio if it has a ratio below 50%, okay? A low geared business might be viewed as safe, may not be borrowed enough to fund future growth, okay? So they might not have enough funds for future growth and expansion initiatives, right? Therefore, shareholders may view low-grade businesses often giving minimum returns, okay, because they're not going to have possibility to expand, they're not going to have possibilities to invest in research and development, okay? And possible strategies to improve gearing ratios is that a firm could decide to not issue dividends to shareholders to increase the amount of retained profit. However, this could cause resentment by shareholders, especially if the reasons for doing so are not well explained, right? A business can seek alternative sources of finance that are not loan related, such as issuing more shares. Okay. The drawbacks is that that may take time to issue shares, and it may go against the objectives of the business because maybe they don't want to dilute, so they're against dilution. So basically, dilution is when too many shares are sold, and the percentage of the ownership of the original owner or the current owners is just gonna decrease by a lot. Who do not want to lose ownership of their business or cause dilution. So like I previously mentioned, okay, so there's so many factors that go into it. So now I'm going to be explaining two key terms in the IB business management that you must know, that I actually already mentioned a bit throughout the video. But basically, you have insolvency. Insolvency is a financial state where individual or firm cannot pay their debts on time. They can't pay for the debts. They're in debt, but they don't have money to pay them back. The individual or firm does not have the money to pay off their debt or obligations, and the debt exceeds their assets. Okay, so basically, liabilities greater than assets. Um, Bankruptcy. Basically, it's a legal process that happens when an individual or firm declares that they are unable to pay for their debts to creditors, meaning that bankruptcy is basically the declaration that you're basically insolvent, that you can't pay your debts to your creditors, basically. It's a legal process for liquidating the property, basically selling the property, so turning it into cash, which is what's liquidating, basically. Selling, which is turning to cash. Basically converting to cash is a better word. And assets a debtor owns in order to pay off their debts. Once all necessary tasks are complete, the firm can be released from insolvency. Okay. That's really it. So basically, when it comes to your gearing ratio, if it's too much, it's risky. If it's too little, it's too safe, right? That's it for the video. Thank you so much for watching. If you have any questions, please comment down below. Please subscribe. Please like. If you have any questions, you can always comment down below. If you want some free tutoring from the Excellence Academy, you can always email me at my email down below. Thank you so much for watching. Bye bye, guys.